Good evening, everybody. It's a pleasure to be here tonight. So today I'd like to tell you a bit more about 3G Capital. More specifically, I'd like to tell you more about the firm's background. I'd like to talk about our investment philosophy. And also I'd like to briefly discuss one of our real-life investment examples. So first off, the most exciting part of the presentation, disclosures. I can see some people falling asleep in the back row, so I better move on. So by way of background, 3G Capital is a private investment partnership that invests in undervalued securities around the world. Our investment universe is very broad, and it includes developed markets, frontier markets, and emerging markets. We practice a concentrated approach to portfolio management such that our top 5 positions account for 60 to 70% of the total. Our investment approach is best characterized by looking for the 3 Gs, good business, good management, and good price. And I know no one in this business is ever going to tell you that they're looking for the 3 Bs, bad business, bad management, and bad price. But a lot of people end up doing just that. So in the subsequent slides, I'll give you more detail as to how we define the 3 Gs. We are also long-term oriented. Anytime we look to invest in a stock, we'll look at an investment horizon of at least 3 to 5 years. We make sure that we maintain a conservative investment profile. We do not short. It's a long-only fund. And we generally avoid leverage. As a matter of fact, since inception, on average, we carried a net cash position. We've been in business since 2004. And as you can see on this slide, in the course of our existence, we generated a track record of significant outperformance versus both the US and international markets. So now I'd like to talk to you about our definitions with respect to each of the 3 Gs. First off, good business. We define good business as a business that is competitively entrenched, generates high returns on invested capital, and is in solid financial shape. So more specifically, anytime we look at a business to assess whether a business is competitively entrenched, we study the industry and the business's place within that industry. So we typically like to stick with industries that exhibit something we call leadership longevity. So we want to see industries where the number ones and number twos tend to stay in the lead for extended periods of time. That gives us confidence to predict how things are going to play out in the future, and so we can actually figure out what the intrinsic value could be. And so then we try to pick out the leaders in those industries. So as long as we can identify number ones and number twos in industries with competitive longevity, we feel like we're looking at competitively entrenched businesses. Further, we like to have those businesses generate returns in excess of the averages with respect to their equity. So we typically look at businesses with ROEs of 15% or above. And then we want to be sure that whatever business we buy, they're actually in solid financial shape. So we look at something called debt payback period. In other words, how many years would it take a business to pay down debt if they wanted to commit 100% of their free cash flow to paying down debt? And typically, we'd like to be under 3 to 5 years in terms of debt payback. It depends on a specific business as to whether we want to be at 2 years or 5 years, because some businesses are more stable than others by nature and can tolerate a slightly higher debt load. In terms of good management, we're looking for management teams that are good at both operating businesses, but also good at allocating capital that the business generates. We also want the proper system of incentives in place, and we want to be sure that management has skin in the game. So more specifically, when we evaluate management, we look at track records for the management team, both with respect to operational excellence and capital allocation skill. So we're going to look and see if management has done a good job improving the business's competitive position over the years, if they maintain a tight lid of costs, and if they made sure to invest in the future as opposed to trying to squeeze most out, to squeeze the cost a little too much and goes up the margin today at the expense of the future. Further, we'd like to see a proper alignment of incentives when it comes to compensation structures. Ideally, we want compensation structures such that align the interest of management with that of the shareholders. And finally, we like to have management have skin in the game. Could be something explicit. For example, they can have a significant equity stake in the business, or it could be something implicit. And you see a lot of that in emerging economies where a government could own a significant equity stake in the business, and then the CEO actually has to be sure to do a good job if they don't want to face repercussions from the government that owns the controlling stake. And finally, the last G, good price. We define good price as a price of 4 to 10 times normalized sustainable earnings. And I emphasize we always look at normalized earnings as opposed to current period earnings. With normalized earnings, we try to get to a number that a business would generate in an economy that is not too hot and not too cold. So we would basically adjust cash flows, margins, and revenues to reflect a normalized economic environment, and then we would get rid of all the one-off items to come up at a normalized EPS estimate, and then we would look at that estimate to buy those businesses at 4 to 10 times normalized earnings or below. And just to give you some context, you can look at our today's portfolio within the partnership, and across the portfolio, our price to earnings ratio today is less than 6 times earnings, and the corresponding dividend yield is about 8, slightly above 8%, and that compares favorably to those same metrics for the S&P 500 at 20 times earnings and a 2% dividend yield. So now that you have a general idea about the company's background and investment philosophy, I'd like to talk about a specific real-life example. This way you can see how we're putting theory to practice. So the company I'm going to talk about is called Silvano Fashion Group. It's the largest mass-market underwear company in Eastern Europe. They're based in Tallinn, Estonia. And the company's brands occupy number 1 and number 2 positions across Belarus, Russia, Kazakhstan, Ukraine, and the Baltics. It is the company's brands and the company's robust distribution system that serves as a significant competitive barrier. And that barrier enables the company to earn unusually high returns on equity. More specifically, Silvano earns 25% plus on equity despite carrying a very significant cash position. And that's actually one of the highest ROEs in the underwear space compared to pretty much any other underwear company in the world. In addition, the company enjoys a significant growth potential. If you look at the structure of the market, you're going to see that Silvano has just 5% of the market, and yet they're at more than twice the size of the next biggest competitor, which suggests a very long growth runway. And on the management front, you see management that definitely has skin in the game. They own 40% of the business, and they have a history of returning substantial amounts of capital back to the shareholders via generous buybacks and dividends. So we discovered that company back in 2014. At that time, it was selling for 4 times earnings or 2 times earnings if you netted out excess cash. If you looked at any other mass market underwear business with a similar competitive dynamic, you'd be anywhere else on the planet, anywhere. You'd be looking at least 15 to 20 times. So it wasn't that difficult to see that it was probably a great value. And they had a 15% dividend yield to boot. So we ended up investing in Silvano. And if you study the outcome, you'll see that in about 4 years, we made about 3 times our money, including dividends, and yet the equity still remains undervalued. So that concludes the presentation, and now I'm happy to take whatever questions you might have.
So is this company, Silvano, impacted by Amazon craze and all these kind of things that we hear about fashion business and retail? And
well, it's not really a retailer. They own the brands, so I'd say they're probably less impacted. That's number one. Number two, anytime you buy underwear, fit is a big deal. So, and you cannot really fit it like over the internet. Not yet, maybe at some point. So like they actually tried to sell it over the internet, and what they discovered is that like it just didn't work out for them because like people were dissatisfied. So because they discovered that people want to come in and try it on, and if it works, like they're gonna buy it.
Yeah, because how can you return, I guess, underwear, right? I mean, you try them and then you return them.
Right, right.
Online. So the high dividend doesn't bother you because North America, people say, if you see high dividend yield, it means that trouble and they may be cutting the dividend, doesn't it?
Yeah, in North America, anytime you see a 15% dividend yield, you're basically saying, look, they either have too much debt and they're going to have to cut the dividend, or the business is actually in its last legs and it's about to go BK. But in case of Silvano, when we bought it, they did not have any debt. As a matter of fact, half their market cap was in cash. So they were drowning in cash. And as far as the business itself, it was doing great. Like they generate 15 to 20% margins, like through thick and thin, tons of free cash flow, very little in a way of CapEx requirements, and a significant growth runway. So when I told people about Silvano, I think I presented it at a conference in 2014, they just said, look, it's just too good to be true. It's like this story about two Chicago economists walking down the street, and one of them said, look, there's a $20 bill. And the other guy goes, no, like there's no bill. It's an illusion, because if it was a $20 bill, somebody would have already picked it up. So I think, yeah. So I don't know of anyone who bought Silvano, even though to me it seemed pretty obvious.
So you have a sell price, or just going to hold on?
Well, look, I mean, if it gets to 15 to 20 times earnings, maybe it's going to be fairly valued, or maybe I'll find something else at 4 times earnings, and then even selling Silvano at 10 times earnings would be a rational decision. So it depends on what else is available as well.
All right, Pavel, thank you for that. I have 2 questions. One, can you just talk about your search process, in which how did you find a company like Silvano? And then the second thing is, can you talk about the risks of investing in international markets and even like some FX issues when you're bringing back money?
With respect to Silvano, it was not a typical process. The way it worked is I go to Belarus from time to time to visit relatives. And this one time I was walking down the street and I see this underwear brand plastered all over the place. Like they basically had like a store in every city block. And I said, well, this is interesting, because anywhere else in the world, like in the US, in Germany, France, Spain, wherever, anytime you have like a number one underwear producer, like it is always invariably very good business. So I just said, you know what, like maybe this company is publicly traded, so let's look them up. So I looked them up, and the like had it, they were publicly traded. And they were publicly traded in Estonia, so we looked at it. And at that specific time that I initially found it, there were a couple of things that I didn't like. Number one, in addition to their core underwear business, where they had like a very good competitive position, and they were also trying to get into apparel and become more like Zara, which I didn't like that strategy, because you can have a good competitive advantage in underwear. Like once you start talking fashion apparel, like it's a totally different ball game. So I didn't like the fact that we're expanding into that. They also expand into retail as well, which I thought was a mistake because you have no competitive advantages in retail. And they had quite a bit of debt. And to top it off, they were selling for like 20 times earnings.
So how did you because they were moving into those spaces, what did you do to mitigate it? Were you talking to management?
I don't know. I didn't do anything. I just waited. Okay. And I waited for about, I want to say 8 years. And by the time year 8 rolled around, there was a new guy, and he whipped it in good financial shape. He got rid of all the non-core stuff. He refocused the company on the underwear brands. They got out of retail. He got rid of all the debt. Like, he ran it like real tight in terms of expenses. He was paying a good dividend. He was buying back shares. So he was doing all the right things. And it so happened that shortly thereafter, you had the Ukraine crisis, and anything related to Eastern Europe became toxic. And the company stock dropped, and it was selling at like, I don't know, probably 5 times earnings before cash, or if you took cash into account, maybe 2.5 times. So we bought it. It dropped. We bought some more. It dropped some more. We bought some more. Anyways, fast forward 4 years, we made 3 times our money. That's how that worked with Silvano. But that's not a typical way of doing it. A lot of times is basically just reading about a place in the world that's going through turmoil, and then we would typically get like a stock manual for that place that lists all the publicly traded companies of size for that specific market. And then we would just leaf through that manual and go page by page from A to Z, trying to see if there are any businesses that look interesting. And once we find businesses that look interesting, then we'll go in depth and try to see if they're worth buying. And then sometimes you end up with a couple of names, sometimes you end up with no names. So not very scientific, but it worked. So, what was the second question? Just currency risk?
Yeah, well, even just investing in international markets. Obviously, you have a currency risk when you're trying to bring money back, but also, governance issues in certain places and things of that nature. How do you get your head around that when you're making investments?
Well, let's start with currency risk. So, anytime we invest, we want to invest in a business that has an implied hedge within that business with respect to currency. Just to give you an example, with Silvano revenues are, even though they're, I guess, formally denominated in local currencies, the reality is anytime they sell a product to, let's say, Ukraine, they would take a list price in euros and convert it in Ukrainian hryvnia at that point in time, at the time of shipment. Okay. So basically, even though like the headline figures are in local currencies, the reality is like all the underlying pricing is sold down in euros. At the same time, you have expenses that are local for the most part. So anytime there is a big local currency depreciation, that's a boon to Silvano because your revenues, they actually stay strong in euro terms, and the expenses in euro terms, they actually drop quite a bit. So if anything, Silvano is a bet, I guess, on the euro, not a bet on the local currency. So when the Eastern European crisis of 2014 took place and all those local currencies tanked, the margins for Silvano went through the roof. It went from like 15 to 25%, it almost doubled. So we do similar things with all our businesses. We'll look at the structure of the business, and we want to be sure that it's either like an exporter, so that effective revenues are denominated in US dollars or the euros, or maybe there is a dynamic within the business such that the costs are going to be local and the revenues are going to be international. And this is a natural currency hedge. Or sometimes if you're talking about, let's say, banks, well, banks have a natural hedge built in because in those economies, you can, I don't know, Turkey, Russia, Brazil, whatever. What happens is anytime there is a currency crisis and the currency depreciates, what happens is you have significant inflation in subsequent years that is corresponding to the amount of currency depreciation. And anytime you have inflation as a bank, you're going to see your assets go up, but that same amount. So anytime you have a drop in your currency, as a bank, you're going to get it all back within probably 2 or 3 years. And like, this is not just theoretical. Like, if you look and study like specific cases, like in Brazil, Russia, Turkey, like, and South Korea, et cetera, like over the years, that's been the dynamic. So those banks, they recover the currency hit within 2 or 3 years. So to a long-term investor, that currency risk for banks is not really that significant.
Thank you very much.
And I think there was another question about the risk in emerging markets.
Yeah, let's keep it going. Yeah, the like governance risk, things of that nature when you're going in. Are there language barriers when you're trying to analyze companies? Do you even talk to management? In the process?
Well, generally not. Like, we've tried to do, like, we've tried doing it. Like, we've tried talking to management. We've tried doing site visits. And at the end of the day, we just discovered that it was really not that effective. And in our experience, there was no correlation between site visits and sort of like feet on the ground and investment results. Now, what we do think is helpful is developing and having, which we actually have that, an intelligence network of sorts on the ground of people who are there 24/7, 365. And those are the people who are industry insiders or maybe auditors, service providers, et cetera, et cetera. So they live and breathe that environment. So we rely on those people to get the scuttlebutt on those names. And I think it's a lot more useful than just sort of just coming out and seeing management once a year. I mean, like, you're going to see them, and I don't know, what are you going to get out of it? They're going to tell you, well, it's all great. Okay, well, you've learned nothing. So. But talking, for example, to someone who is an auditor in China, and that person audits Chinese publicly traded banks, well, that's an eye-opening experience, because he's going to tell you how things look under the hood of the Chinese banking sector. So that's a lot more useful. So we have a lot of people like that in our network all over the world, and we rely on those people to help us out with research.
Thanks, Pavel. Yeah, I just had a question more about emerging markets again.
Sure.
Just your company's rationale for pursuing value in emerging markets. I know a lot of value investors avoid it for the reasons that you just talked about. So is that because you're unable to find a lot of opportunities in traditional markets, or is it a reactive measure? Or?
No. It's like, we're not dogmatic. Like, there is nothing ideological about us saying, well, we want to be in emerging markets. Like, I'm just as happy to invest in Canada or the US or the UK. But I think at the end of the day, what you do, you go around the world and you try to find the best deals you can. And the best deal you can, I guess the way to find it is you look at all the assets across all the markets, you look at the nature of the asset, and then you look at the price for those assets. So as a result of that, you're going to end up with, I guess, the expected return and risk. And I think in the recent years, what we've been finding is that the assets in emerging markets, with respect to investing in them, they've been less risky than those in developed markets. And a lot of it has to do with the fact that, in addition to sort of the nature of the asset factor, you have a price factor. And an asset at a certain price could be risky or it could be very safe. And it's not always going to be like that, because I remember back in 2006, 2007, emerging markets were priced as if they were less risky than the developed markets. And that was the perception. I think in the past 3 years has been the reverse. People were saying, well, emerging markets are risky. But again, at the end of the day, you have to look anywhere you invest, developed, frontier, emerging, you look at the nature of the asset and the price for the asset. And then you try to find the best deal that you can. And it just so happens that those deals are now being found in emerging markets. But it's not always going to be like that. At some point, we might be finding more low-risk, high-return deals in the developed markets as well. That could happen. So it just basically the best deal wins. And if it happens to be in an emerging market, well, so be it.
So 3G owned Alarm Force for just about a decade before you sold it at the end of last year. Would you be able to walk us through your original thesis as well as why you sold it?
Yeah, sure. So the original thesis was that you had this business that had a significant competitive advantage within an industry where everybody else did things in a highly inefficient manner. So more specifically, if you look at the home alarm industry, what you see is that pretty much all the players distribute their services through a network of dealers. Unlike everybody else, Alarm Force distributes its products and services direct to consumer. So they take out a huge layer of cost. And as a result, they were able to sell their product and service cheaper than everybody else, and yet they still enjoy significant margin advantage. So when I looked at Alarm Force and the structure of the industry, it reminded me of Geico back in the day, because Geico had like a very similar industry structure and a very similar advantage. And with Alarm Force, I thought, well, look, you are going to be in this large and growing industry. You have probably 0.1% of the market share. You have a significant cost advantage versus everybody else, and you have the industry structure that restricts adaptation. Because if you sell through dealers, it's very hard for you to say, well, I'm just going to start selling direct because that's going to, piss off your network and they might leave. So that was a theory, and it was working well for the past, early on for the first maybe 4 or 5 years. And then things got off track a bit. There was a significant technology change within the industry. There were changes to marketing channels, and there were changes to the product suite as well. And those were tough challenges, but they were not insurmountable. So I think you could have overcome those challenges, but management struggled to do it. So the company did not grow as much as I originally expected. But in the right hands, that business was still worth a lot of money, because at the core, they still retained their low-cost advantage. And the industry structure was still such that existing players could not adapt their marketing strategies to sell direct. And that was not lost on potential buyers. And in November of last year, Bell decided to make an offer for Alarm Force at a 65 or 75% premium. And so we ended up selling. So we really didn't have a choice. But at the end of the day, we still earned a good IRR, depending on the time of purchase and the price of purchase, because we purchased Alarm Force at a number of different times at different prices. We earned anywhere between 14 to 23% IRR on that investment.
Another follow-up question on kind of the risk associated with investing in emerging markets.
All right.
You mentioned that you determined that this is a good company to buy because the earnings multiples is a lot lower than the other players, but it's also because of the fact that it is in an emerging market. How do you quantify the risks and say that it is underpriced not because of the risk associated with it, and all the assets are priced lower because of the risk, or the fact that it is actually a value buy? How do you determine that? So
basically what you're saying is that maybe they deserve to sell at a lower multiple given all the political and whatever risk in those. Well, let's say I buy into it. Well, there is still going to be a multiple at which that company is fairly valued for an emerging market. And if you can buy it for half that multiple, it's still a good deal, low risk, right?
Yeah, that makes sense. But is there a way to quantify it, I guess, that you would use when you look at an asset?
Yeah, but let's tackle another aspect of your question. So you're saying it's riskier to do business in Estonia or Belarus compared to the US or Canada. I've met people. Well, here's an example. So I know this guy who lives in Moscow, and he's got all of his money invested in Russian equities. And I'm talking to him, I'm saying, well, why wouldn't you diversify? Why don't you take 20% of your monies and invest it in US equities? That's going to be a lot safer for you. And you know what his answer was? No way, it's too risky. I'm scared of the US. They had Madoff, they had Lehman, they had Enron, lots of fraud in the US. I'll never do it. In Russia, it's all safe, no fraud. Okay, and if you talk to a person in Turkey and ask him about Turkey versus the US, you're going to get the same answer. And you talk to a person in Brazil, he's going to give you the same answer. So I think a lot of those perceptions about risk outside your home base, it's probably more of a my side bias than reality. I mean, you look at how the banking sector is regulated in China versus the US. I'd argue there is a lot more political risk in the US than China. Like, you look at how many banking crises you've had in the US in the past 100 years versus, I don't know, China. Like, US had more. So why would you say Chinese banking system is more risky? And like in China, the government knows that banks have to make money. They're essential to the economy, so they're going to support them. Same thing goes for Turkey and Russia. Like, there's no bank bashing. But in the US, oh my God, like since 2008, I mean, it was like nonstop. Those banks are bad. We got to cut them back. They cannot be earning that much money. So like, where do you have more political risk? In a place where people want businesses to succeed, or where you have this anti-business rhetoric? So I guess this is not to say that Russia or China is a better place to do business compared to the US on average, but I'm just telling you that like there's another side of the coin. So you have to ask yourself a question. In the past 10 years, how many businesses get nationalized or quasi-nationalized in, let's say, Russia, which is a bad boy for corporate governance, versus the US? And the answer is, in the US, you had Fannie and Freddie, 1 and 2. Then you had like Wells Fargo, JP Morgan, partially quasi-nationalized. So that's like 4. Then you had GM bondholders, who basically were supposed to get their money back, but then the administration said, well, you get, the unions are in front of you in line. And in Russia, it hasn't happened in the past 10 years. Again, like on average, like US is a much better place and a much safer place than Russia, but I say just to assume that like Russia is a 0 on a scale from 1 to 10, US is, or Canada is like 10 on a scale of 10, that's probably not the case.
So I have a couple questions. I guess first of all, like, do you only think about valuation in the context of like low PE multiples, or how else do you think about that in terms of the whole investment process?
No, like I don't want to make it sound like all we care about is low PE. Like the first thing we want a business to have quality. And by quality, again, it means that it has to be competitively entrenched. It's got to generate good returns on capital. It has to have solid financial condition. It has to have the right management. So once it cleared all those hurdles, which is probably 99% of our time is spent thinking about those things, well, then you're going to look at the multiple. And the multiple is going to be on normalized earnings, not on sort of current period earnings, right? Because like sometimes the business is investing in growth, well, and it's doing so through the P&L. Well, to the extent that it happens, we're going to adjust the price earnings multiple. Because like when we bought Alarm Force, on the current period earnings, it was like 16 times earnings, right? But like if we adjusted the multiple to normalize it, it would have been like 9 times earnings. Because we would have said, look, if you invested in growth, well, this is essentially CapEx. This is not really an expense. It just happens to be on the P&L for Alarm Force because of how accounting works. So PE is really just sort of more of a crude metric, assuming everything else checks out. Because if we find a business at low multiple that doesn't pass the sort of quality screen, well, we're just not going to be attracted to it at all.
Okay, that's fair. And then I guess like, what does the sort of like diligence process look like? Because you have such a limited amount of time, and like because you guys are pretty small, like how do you decide how to best allocate your time to certain ideas because the coverage universe is so broad?
Well, there is no scientific system to it. It's like I said before, you try to go through country manuals and just go sort of through A to Z and try to find those businesses that look interesting. A lot of times you're going to find a business that looks interesting but not cheap enough. So you're going to go through it and you're going to put in the database. And then to the extent that you build a database, at some point, that business is going to be attractive and you'll buy it. So in addition to sort of going through those stock manuals for different countries, we also have a database that we accumulated over the years of probably 300 to 400 names of businesses where we've done quite a bit of work. and businesses that look interesting. And if we see them becoming attractively priced, like we could pull the trigger pretty quickly.
Hi, I have two questions. The first one, I just want to confirm you do not have an industry screen of any kind.
No, not at all, other than maybe in my mind, but
Okay, that segues
does it
wonderfully.
qualify?
Oh, yes, it segues great into my second question. So we've heard from many value investors of these unique mental habits they have to keep themselves from making mistakes. Some take a nap, some go on a walk. Do you have any habits that you use in your value investing methodology?
I don't know. I guess I eat once every 4 hours. And I get 8 hours of sleep every night. Outside of that, I can't really think of anything really. No, sorry to disappoint. Yeah, really, I can't really think of anything. No.
All right, thank you.
I just sort of wake up and read, and then, by the time I'm done, I go to bed, and I guess that makes my day. So.
Thanks.
Hi, do you mind kind of just walking through what steps you take to evaluate management and how you really define what good management is to you?
Sure. So what we do, we place high value in studying track records. When we look at a business, we would see what has the management done over the years, and we're going to look at the operational performance of the business. Just to use a specific example, when we looked at Silvano, we looked at the fella who runs it, and we said, well, how did he do operationally? And when he took over the business, that was around 2009, it was a business that had quite a bit of debt, not so great margins. It was fairly cyclical. They had good core mass market underwear business, but they had a lot of other stuff like retail and fashion apparel. So it didn't really have the focus. And then if you look at what he has accomplished during his term at Silvano, he basically pared back all the non-core activities. He refocused the business 100% on the business where they actually had the advantage, which was the mass market underwear business. He basically paid out all the debt, and he squeezed cost quite a bit. So he improved margins by a significant amount. And he also took advantage of market fragmentation, and he increased sales quite a bit by using an innovative system of store development, as opposed to having Silvano put money at risk opening stores. He actually banded together with franchise partners, and he would basically spec the stores for them. He'd say, well, this is what you have to make the store look like. Here's what you have to have at the store in terms of staffing levels, et cetera, et cetera. But you're going to be taking the real estate risk, and you're going to run it how I tell you you're going to run it. And he's had great success growing without actually having to put capital to work. So if you look at that, you'd say operationally, the guy is pretty astute. Like, that record speaks for itself. And then you move on to capital allocation. You say, okay, did the guy do a good job? Well, he actually generated quite a bit of free cash flow. What did he do with it? Did he spend it on empire building, or did he put it back in the pockets of the shareholders? Well, he's paid significant dividends. In some years, the dividend yield was as high as 15, 16%. And he did quite a bit of buybacks when the stock price was cheap. So I'd say in terms of capital allocation, he earns an A+ as well. So it's not that difficult, and the guy owns 40% of the business. And by the way, I never talked to him, and everything I hear that he is, I guess, a bit of a hard ass, but it doesn't matter. If I look at his track record, that tells me whatever I need to know, because those sort of speeches don't make that much of a difference. It's more about what have you done. And I think if you listen to Buffett, people ask him, well, how are you so good at evaluating those managers? And he's like, well, actually, I'm not that good, because all I do, I just look at the track record. I don't talk to the guy and say, well, talking to him, he seems like a great CEO. I just look at what they accomplished, and that's what tells me if they're good or not. So this is pretty much what we do.
Okay. So do you also engage with management at all after you've acquired a stake?
Sometimes I do. I'm not opposed to it. I don't feel like we need to. Sometimes I do it because it helps me learn a bit more about the business. Maybe he'll tell me about other businesses that he knows and respects. But it's more out of intellectual curiosity rather than necessity. But if they want to talk to me, fine. If they don't want to talk to me, that's fine too.
I'm really interested in your business, not so much how you are allocating capital, but in terms of your investor base. You run a partnership. Do you think that creates a competitive advantage against other money management firms? Are you restricted in where you can invest by being in the locations that you're in? Things of that nature. If you can talk on that, I guess.
Sure. As far as being restricted, the answer is no. We're not restricted. We can go anywhere. But obviously, anytime we look at a business, we're going to look at the business itself, and then we're going to consider the context, be it geopolitical or geostrategic or what have you. So that plays a role as well. In terms of being a partnership, I think it does create a significant advantage. And I think our structure of having a 2-year lockup also has a very significant advantage versus other funds. If you invested with us, you could only take money out once every 2 years on December 31st. So what it does, it really aligns the investment horizon that we have with the asset base that we have. So the only reason we're able to generate the returns that we have generated is because we have the investor base that buys into the long-term approach. Because if you gave me a fund with later liquidity and you said, you know what, can you please do the same thing you've done with your fund, I'd say cannot be done. So that's an advantage, and I think the small size of our team is always an advantage as well, and we have that because in my experience, anytime you have a big team, what happens is you introduce politics into the equation. There's a lot of people sort of competing with each other, a lot of different approaches with respect to, I guess, the concept of what you look to invest in. And at the end of the day, like your investment process is going to be run sort of to the lowest common denominator, and is going to be consensus driven as opposed to common sense driven. So not having too many people in the team definitely makes a big difference.
Are you targeting a specific group? Are you looking for high net worth individuals? Are you going, like, how is it that you were able to raise the funds to start the business, I guess?
Well, I wish I knew the answer to that question. They sort of just come out of the woodwork. We never had a concerted marketing effort. It's more or less just the word of mouth. People just hear about us from somebody else, and they knock on our door, and sometimes they like it, and if they do, they invest. We actually we hardly have any investors in Canada, even though I live here, which is surprising. But like we have investors in the U.S. and Germany, Switzerland. We actually even have a university endowment two out of Spain. We have one person from Hong Kong. But it's completely random. Like we spend zero time on marketing. Like I want to structure my life in such a way that I could concentrate on just looking for ideas 24/7 and like do nothing else. So that's the objective.
Is there an advantage to you being in Canada versus somewhere else? Just preference?
No, I don't think so. Like sometimes people say it's good to be away from the noise, but I don't know. I live downtown Toronto and I feel like I'm away from the noise. I spend almost all of my time by myself. I don't need to talk to anybody. So I'm just as comfortable thinking about stocks, I guess, in the middle of downtown Toronto compared to, I don't know, North Carolina or Kansas City. That wouldn't have made a difference.
So the Silvano case was something that went according to plan. I'm wondering if you could give us some insight into an investment, a value investment that you either participated in or were witness to where things didn't go according to plan. But before you made the investment, it was a sure thing. What went wrong? What did you not think about? What changed over time?
Well, there are way too many of those. But I can tell you about one specific case for sure. So, and that goes back to 2005. We invested in a company called Pier 1 Imports. And how I stumbled upon that company, I was following the filings of Berkshire Hathaway, and I noticed that Berkshire Hathaway more specifically Lou Simpson, he purchased Pier 1, and Pier 1 is a retailer that sells home furnishings. And they're considered to be like on the higher end, and they have like a good number of SKUs, like it's a nicer looking store. And I was looking into it, and I just said, you know what, like Lou Simpson bought it, so it must be a good business. Looking into it, I said, okay, so they're number one in home furnishings in the US, which tells me that you're probably going to have this dynamic of number one, number two, which means that I can probably predict that Pier 1 is going to keep being number one for the foreseeable future. So in a nutshell, that was the thinking process. And where I made a mistake is I completely misjudged the competitive nature of the retail business, partially because it was a mistake. I never did as much work as I should have done because I sort of relied on somebody else. In that case, Lou Simpson. I figured, well, how can the guy be wrong? So I ended up losing some money on Pier 1 because, as I learned later, retail is basically a commodity business. And when people come into the store, which I know, like, hindsight is always 20/20, now it seems pretty obvious. Wasn't obvious to me at that point. People look to buy on the basis of price. They don't care if they get like a nice customer service associate. They don't care if you have like nice tile on the store, on the floor in the store. They don't care that much about the number of SKUs. What they care about is price. So, and how you win in a commodity business, which the retail business is you have to be the low-cost producer. So, and specifically in retail, the winning model is low expense ratio and low gross margin. That's how you win that game. And Pier 1 just didn't have that, so they fell apart. But I did learn from that mistake, and the learnings basically I just summarized to you. So when we stumbled upon another company that looked really cheap, it was like 4 times earnings or something, and they were like the leader in the off-price space, and the company was out of Boston called Tuesday Morning. We'll look at that, and it had all the hallmarks of what we'll look to buy, but looking under the hood, we just realized that, hey, look, this is a business that does not have the cost leadership. And they were doing well at that time because TJ Maxx and Ross Stores, they did not invade their turf yet. But it was only a matter of time because I think they had like expense ratio of 20%, which was way better than department stores at like 30, 35. So they were killing department stores and doing well, but like TJ Maxx and Ross Stores, they had like 15%. So like you knew, like once they started going head to head, they'd be done. So we never invested in Tuesday Morning for that reason at 4 times. However, we started looking at TJ Maxx and Ross Stores, and those guys came up as like the 2 best in class, one on the East Coast, one on the West Coast. And we could tell that those were destined to be the leaders of the retail industry due to their solid cost leadership. And we bought Ross Stores, and we actually paid like 11 times for it. And we've done phenomenal. Like we bought it just before the financial crisis in like early 08. And I think we've owned it for 2 years, and like it more than doubled, even though like the stock market was still down. So again, like we paid a price that's sort of on the surface of it seemed to be a lot higher than the alternatives. But like I said, like we want to be sure that the businesses that we buy clear the quality hurdles. Unless you clear the quality hurdles, we're not even going to be talking pricing. Like if you say 2 times earnings, like we're not interested unless we know the quality hurdles have been passed.
Hey, Pavel. I read a little bit online that you first started a few companies yourself. What made you transition from an entrepreneur to investor, and what was your first success as an investor?
Yeah, you're right. Like as a teenager, like starting about 13, like I ran a lot of different businesses. However, I was specifically always searching for that business that would keep me engaged and interested for the rest of my life, something I could be interested in, like even when I get to the age of like 90. Those businesses that I had run at that time, they didn't have that. I needed something that would force me to learn something new every day. and something that I could build on a global scale. So that's why I was always searching for a business like that, and finally stumbled upon investing. And I thought, well, this is it. This is something I can do for the rest of my life. So that was the reason for transition. But I don't think I gave up being entrepreneurial because, like, I started my own firm, right? So it's still, I'm still an entrepreneur. It's just a different business. It's not selling rebar or publishing a trade publication, but it's still being an entrepreneur, running my own show.
Your first success as an investor?
My first success, well, actually, maybe I'll start with a failure because I started with a pretty big failure as an investor. At that time, I published an accounting publication over in Belarus, and I was like 16 or 17, I forget. And as I was sort of contemplating getting into investing, I thought, well, maybe I should invest in some stocks. And at that time, I talked to someone, and that someone said, oh, you know what, we've been buying those Russian stocks, and they're just great. They're just going up every day. So I just said, okay. So I took whatever money I had, and I put a bunch in a bunch of stocks, and that was like right before that Russian financial crisis. And then like I lost 90% of it. So that was the first experience. In a way, it was a success because it did help me learn that you cannot be outsourced and thinking to somebody else, especially when it comes to money. So, and then subsequently, when I was in the U.S., I started a managed account when I was still at Western Kentucky as an undergrad. And I ran that account since 1998 through 2004. And I think I generated like probably 20% per annum, versus the S&P over the time period was probably flat. So that was the first success. And I still remember, like, I owned TJ Maxx was one of the businesses, then First American Financial, Old Republic Insurance Company, D.H. Horton, and Lennar, the home builders. So those were the 5 stocks. And I picked them out as I went through Ben Graham's book. I just said, makes sense in theory, let's try to put it in practice. And I put it in practice with those 5 stocks, and it worked out well. And that's what sort of made me think, you know what, maybe I should start my own firm. Because when I worked for other firms, I was showing them my track record saying, look, you know, if you can generate 20% per annum when the market is flat, isn't it great? Let's start a product like that. They just said, oh, you don't understand. That's not the way the world works. And I just said, well, maybe I'll just do it myself.
In the meantime, I guess, can you tell us how your day looks like? Like, what do you start in the morning, wake up, and what do you do next? You go to work, and then you don't market anything. So what does your day look like? You read a lot, or what do you do?
Yeah, it is. It's going to be the most boring story of all the stories you've heard. So I wake up, I have breakfast, then I start reading, and then I keep going until probably 6 or 7 p.m., Then I break for dinner, and then spend some time with my kids. And then when they go to sleep, I go back and maybe do another couple of hours of reading. And there's a whole bunch of stuff that I read. Like, I read annual reports, I read research reports, I read trade publications, I read things like Barron's and Wall Street Journal, The Economist. I read some books on business and investing, and I read a lot of stuff on like anthropology and like I guess human brain development, and a lot of stuff that's like not related to business at all. But I still think you can sometimes learn something that you'd apply to business as well. So just everything. I have a stack of stuff on my desk. It's about this tall, and I come in, and by the end of the day, maybe it's a little shorter. But other than that, I don't do anything else. So maybe I occasionally speak with my partner. Outside of that, there's really not much else. So yeah, I don't run around looking busy at all.
So Pavel, I think you mentioned earlier about some of the banks in China and compared to the U.S. So I was just wondering, because a lot of the banks in China, they were nationalized with the support of government. So I was just wondering, when you're doing the valuation process of, let's say, example of a bank in China, how does it different from, let's say like a bank in U.S. and would you factor in some of the risks, like in the political side, in terms of the macro level?
Yeah, I would definitely factor in the risk because if you're talking about a bank in the U.S., you're going to have so many people having an axe to grind against those banks. So, like with a U.S. bank, you're going to always have a risk that the regulators are going to go after you. In China, much less so if you doing the right thing. So you have to factor that in. Then you have to look at the setup of the banking system and the oversight. If you're talking about the U.S. and Canada is actually going to be very different, but in the U.S., you have a bunch of different regulators. So like you can regulate a shop in the U.S. and what happens is like there are a lot of people who slip through the cracks. You also have a lot of people who are really like driven by profits so much that they're incentivized to start cutting corners, and you don't really have that in China. In China, if anything, like it's a cultural like risk avoidance, especially if you're talking about like the big five and even like joint stock banks.
Right.
I mean, they really want to be sure that like they run so safe that like no crisis is going to put them out of business.
Yeah.
And in terms of oversight, if you look at China, I mean, like the sampling rates for loans in China for auditors, let's say you are, I don't know, PwC or whoever, Deloitte, like you go in, it's like 70 to 80%. The sampling rate in the US, like at Wells Fargo, it's 5%. And then if you look at like how it's done in China, you're going to have those people like parked at your offices talking to people as like on the ground sampling and checking. In the US, it's like it's an IT audit. Like they want to basically minimize that labor cost. And again, you are going to have some risks with that. Now, you got to keep in mind that in China, like the regulators are smart and on top of the ball, but the fraudsters are also very smart and on top of it. So
Yeah.
it's a different dynamic versus the US. But, I think if you're talking like the top banks in China, they're sort of close to the emperor, so to speak. Well, like the oversight is very good. Like once you get into the nooks and crannies of the Chinese market, like you're going to see some banks where like the loan books are realistically like bad, so bad that maybe like 50% of loans are non-performing, but they're not showing it obviously. It shows maybe 3%, but technically like those are bankrupt. You're going to see it, but with enough work, you can figure it out. It's not rocket science. So that's the overview of the Chinese banks. I mean, and you can, the other thing is, I think you have to see how the banks are treated by the regulators and how that impacts you as a minority shareholder. Right. If you look at the US, during the savings and loans crisis, back in, was it like 88? I forget the exact date. You had a lot of loans going bad. So when the regulator came up with the solution, they said, we're going to create a bad bank and we're going to take those loans off the books of the banks. Well, when they did it, they came with a 50% haircut. So as a minority investor in those banks, like you suffered. And that basically regulator said, look, in the US, that's our approach. Like you're going to have to suffer. When it happened in China back in the 90s, I think, the bad banks that were created, they took those loans off the books of the Chinese banks at face. The Chinese government made sure that investors, minority investors, didn't suffer. So that's the difference in the regulatory approach. Plus, in China, the regulator has a lot more tools at his disposal to manage the cycle versus in the US, it's not as easy. So it's a lot less centralized, so it's harder to respond. I've heard some people say it's actually better to do it the US way because they said it's better that you have a crisis from time to time because that sort of keeps you on your toes and alert. I don't know. It's like, I'd say perhaps that this is not the case. Perhaps if you can run it to where you have no crisis, maybe that's not that bad. So, but I guess this is the difference between the Chinese approach and the US approach when it comes to regulating the banks.
What advice would you give to students who are getting into, let's say, the industry of asset management, and what would you wish you would have done if you were backing our position?
Well, so first off, the advice, I would say that you probably want to find the specific segment of the finance or the investment profession that you enjoy the most. You want to find an occupation where you're going to be happy with, I guess, for the rest of your life, and it wouldn't stress you out to be doing it 24/7. And then you want to learn as much as you can about that segment, and I'd say that would be a recipe for having a successful career and probably a happy life in general as well. So, but easier said than done.
What would you wish you would have done if you were back in our position as students?
Frankly, I wouldn't have changed a thing. Yeah, like that. Look, I mean, sometimes people say like, if I could go back, like I would have made sure that I didn't make those certain mistakes. Look, in my experience, you make those mistakes, but then the learnings from those mistakes are going to be so valuable, and they're going to propel you forward, that if you did make those mistakes, well, you might have been worse off. So that's why I have no regrets whatsoever. Like I wouldn't have changed a thing.
You briefly mentioned, so you don't visit the site. Instead, you have like people who sort of tell you about like sort of the performance of a company. How do you go about acquiring these people, and like, how do you like?
Well, that's the trick. Now you want me to reveal the secret sauce? But on a serious note, again, nothing scientific. It's basically a lot of times it's just picking up the phone and talking to people. And especially if you get to like Canadians or Americans who live in those places, like normally it's a pretty tight group. So once you get to one, you're going to get to the others as well. Like sometimes you're going to see a guy profiled in a newspaper or a magazine, and then a lot of times you're just picking up the phone, just calling him up saying, hey, I read about you. I'd love to talk to you some more about the Chinese banking system, or the Russian oil and gas industry, or the Brazilian cosmetic industry. So, and a lot of times they're going to be willing to talk. If you look at 3G Capital, not our 3G Capital, but the Brazilian 3G Capital, which we have nothing to do with, how they actually became successful with their retail business is they basically called up Sam Walton, basically out of the blue, and they just said, look, we're from Brazil and would like to come and see your operation. And Sam Walton said, sure, come on in. So they flew over, and he took them on a tour, and he told them everything there is to tell about like running a discount retailer. And then they went back to Brazil and they applied that to the business that they ran, and that business was successful. And if you look at O'Leary, the guy who runs Ryanair, that was no different. So O'Leary is the guy who called up Southwest. He just said, hey, I'm from Ireland. I'm a big fan of yours. Would love to learn more about Southwest. And he came over, spent a few days, and then he applied a similar model, although probably made better to the European discount air travel. So I think a lot of it is just that. So there is nothing proprietary. There is no formula. There is no AI, machine learning, or any of that sort. So it's just, I guess, picking up the phone and calling people.
So like as an investor like ourselves, like students, we don't have the reputation to sort of call Sam Walton the other day and like how would you advise us on like collecting information from like the scuttlebutt method?
You know what? Sometimes you don't need the reputation, especially like my experience is if you call in a different country, people are going to be a lot more willing to help because maybe they don't perceive you as competitors. Because if Sam Walton got a call from a guy in Kansas City who wanted to learn about discount retail, like that guy wouldn't have gotten a call back. So again, like even back in my student days, all I did, I would just pick up the phone and I would just call. And a lot of times, like I had people who would want to talk to me, even though like I didn't really have any reputation, nothing. So it still happened. Yeah, so beyond that, really, I can't really offer any more useful advice. At least that's how I've done it. So maybe there's another way. Yeah.
Okay, let me ask you a couple of two last questions, then we'll call it night.
Sure.
Maybe related. What you know now that you wish you had known 13 years ago?
Well, the only one thing, and that would be my advice to those of you who would like to start their own firm down the road, I would basically set up a managed account and run your investment portfolio within that account and have it audited. Because that way, if you're going to go out and look for money, this is going to be a big selling point. This is going to be something that's like real life, practical, audited, 100% solid. So that would be probably the biggest piece of advice I could give to those who are pursuing careers specifically in investment management.
And finally, what is the most important thing you learned in investing over the last 13 years?
Well, the biggest thing is that you have to trust your own work and you have to trust your own judgment and no one else's. Even if you talk in like Warren Buffett or Munger or whoever, at the end of the day, you have to buy stocks for the reason that you understand and based on the research that you've done.